Welcome again. This is your tutor, none other than CP Rono, and today we are going to look at the financial reporting and analysis, and we are going to look at the concept of how to master the tricks of answering the group's accounts when it comes to exam. Tricks of mastering the group's accounts when it comes to exam. So you have to note the adjustment. Guys, we have the adjustments when it comes to groups accounts. We have the adjustments when it comes to the groups account. One of the adjustments which you need to understand, number one, is unrealized profit. Unrealized profit. What is this unrealized profit? What is this unrealized profit? When we talk of unrealized profit, it is something that we have not received. It is yet to be received. And this one, it is coming from the group's account. Maybe the parent company sells goods to the what? To the subsidiary company, but the subsidiary company have not sold that goods. They are still in their inventory. So that's what we call it. There is a profit, there is a line profit there. So we call it unrealized profit. What do? We need to adjust. We need to adjust our revenue. We need to adjust our revenue, which is the cost of sales. So you add back to the cost of sales and also subtract in the part of the inventory. So this one you have to know. This one you will cost of sales we add, and then the inventory we do what? We subtract the inventory. And then number two also is UPFA. What do we mean by this UPFA? This is unrealized profit. This is unrealized profit on a fixed asset, right? The parent company assigns a fixed asset to the subsidiary company at a given margin. So you remember, there is no third party transaction here. We said for a profit to be recognized in the group account, there must be a third party involvement. But here, we don't have a third party involvement. So what happened is, the parent company normally sold the fixed asset to the subsidiary at a given profit margin. And how do we get this UPFA? You need to understand the UPFA. You get the profit margin. You multiply by what? The depreciation rate. You multiply by depreciation rate. And then number three adjustment is what is called the intercompany owings. Intercompany owings. When we talk of intercompany owings, remember, when you are in business, you sell goods on credit and also you buy goods on credit, right? So the parent company and subsidiary company, they owe each other in terms of the receivables and payable. So whatever it is there in the parent company as a receivable should be there in the subsidiary company as a payable. So you must adjust the two. How do we adjust this? Subtract the receivable, and also subtract the payable. That is intercompany owing. Another adjustment which they should have come first, but we decided to bring here on number 4 is called goodwill. What is a goodwill? If you are not in a finance account, or you have never been in a class of accounting, what is a goodwill? With the goodwill, when we leave this group's account, the goodwill is just that a reputation. But in group accounts, goodwill is not a reputation. Goodwill is the difference between the purchase consideration and the net realized assets. So with this goodwill, we can be able to get impairment can be able to get the impairment of what? Of goodwill. Can be able to get the impairment of goodwill. And where do we take this impairment of goodwill? Where do we take this impairment of goodwill? My good friends, my good learners, give a comment section there. Where do we take the impairment of a goodwill? Goodwill will affect this. Goodwill will affect the P&L, profit and loss account. The goodwill will affect the P&L, profit and loss account. And also, it will affect the NCI. It will affect the NCI